Hey everyone, Sean Taggy here at Memphis Investment Properties. We have one of our famous lenders with us today, Mr. Joe McBreen. Joe, how you doing today, man?
Hi, Sean. Good to see you. Thanks for having me.
Yeah, man, we're excited to have you on here and to shed some knowledge, from your years and decades of experience in lending, and hopefully you can help, some of our newer investors and more experienced investors, understand a little bit about leverage and how it can be used as a good tool for them. So,
Sure.
yeah, man, let's dive right in. First, let's just start a little bit about you. Tell us a little bit about yourself, how you got started in lending and all that.
Well, I'm from Ireland originally. Some folks on the call may obviously have worked with us in the past, so they know that already. But some of the newer folks, my background is I got lucky. I got my green card in the lottery. I came over to the States about 25 years ago. I started waiting tables, just trying as a young guy, just trying to get by, and I ended up getting a job in the Chicago Board of Trade, and I worked my way up there to basically being an arbitrage broker. So I was trading U.S. Treasury bonds. I left the bond floor and went to the Mercantile Exchange, where I traded S&P, NASDAQ, the Russell 2000 index. And did that for a number of years. Obviously, it was pretty hectic lifestyle but it was good because I was young and single and didn't really have much responsibility by way of life responsibilities other than to continue to work and grow my career. And that certainly went digital, so without the financial backing to stay in trading, I had to find a new career. So I got lucky and got a job with a bank here in Chicago who was growing in the Chicago market, and I started writing mortgages. That was in early 2001, prior to obviously prior to 9/11. So kind of got lucky. Rates at the time were at for a 30-year fixed primary residence were at 7.5%, 7.75%. And then post 9/11, obviously we had a mini recession and rates kind of dipped down for about 6 months. And I learned how to write mortgages. I learned how to kind of build the business a little bit. I built my client database. And then we had a prolonged recession in 2003, which again helped with just the repetition of refinancing and learning the business and building my database. Started really doing it that way as a mortgage. So back in 2001 is when I started writing loans, and got really involved in the turnkey stuff after the 08-09 kind of Great Recession, where a lot of folks in our industry kind of, just had to exit the industry. They just couldn't survive. Luckily enough, I had done enough marketing and growth over the years prior to the recession to survive those lean years. Right. And coming out of the recession, then we looked at the landscape, and sure, rates were pretty low, and QE1 and QE2 and QE3 was happening, and the Fed was, kind of supporting the industry, so to speak, after the housing crash. But we looked at the turnkey model and we said, okay, this is a niche area of financing that we can kind of concentrate on, where we don't have a lot of competition, only because the loan amounts are so small, and a lot of loan officers they won't do a $60,000, $70,000 loan.
Not worth their time.
Yeah, they want the $1 million deals, and I'm like, So for us, it was a matter of, building the database was always been about customer experience and execution of loans. And with the turnkey model, we don't care whether it's a $50,000 loan or a $500,000 loan. We do it all. We're a full service residential lender. But in the turnkey world, we figured that, the more units we can do, the more people we can, customers we can touch, and the more folks we can help and build a business that way. So we've been doing the turnkey stuff now for going on 7 years, I would say. We concentrate, we've built a team. Maggie and I are the loan officers on our team. We've built the team up to about 8 or 9 people that help us with dedicated processing, dedicated underwriting, dedicated closing, so we can execute our loans very quickly. We typically will close anywhere between 70 and 80 turnkey loans a month.
That's great.
So there's not a lot that we haven't seen as it relates to borrower characteristics, Fannie Mae, Freddie Mac guidelines, or just, self-employed borrowers, whatever the case may be. We typically don't come across too many surprises that we haven't seen or can't handle or get past. So I always tell folks that, it might be your first deal that you're doing with us or your first investment property that you're buying, and sometimes can be a little bit overwhelming and stuff, especially with the paperwork that we require. But once you get past your first one, I tell my team, I'm like, if we're doing 60, 70 loans a month, we should be good at it. And that's the expectation I'm going to give our clients.
Right.
So we hold ourselves to a pretty high standard. Nothing's ever perfect, of course. And, things do happen as it relates to, financing at times. There can be delays with construction. There can be delays there can be appraisal issues, whatnot. But generally speaking, we try to communicate that as best we can so that we set the expectations properly for everybody.
Wow. Joe, man, thanks for sharing your story. I'm sure a lot of people can relate through the '08 crash. And man, I think any lender or anyone in the real estate industry that can make it through the '08 crash, I mean, it just shows that they have experience and they're already a cream of the crop, because only, 20% of the people made it through that. So I think that shows a lot to our listeners here and our clients that, you definitely have the grits to last through the hard times, and you adjusted. I like that a lot. Also, I like that, you're just not a one-man band. You got a team rolling, and they're there to support you and Maggie. I know you guys are the dynamic duo, as I call it. So that's great, man. So, most people, so for our newer listeners, we'll get into some more deeper questions in a bit, but just kind of go over, the conventional loan and what it takes for them to get their first rental property. Let's say it's just their first time. What do they need to do?
Well, I think it's, everybody needs a comfort level too, right? So if you're like I call a novice investor, you're just starting out and you're getting your first property, your first two properties, and you're getting your toe in the water as it relates to the experience there. It is important, obviously, to have a lender. Like, first, we have a big advantage over some other lenders in the fact that we're licensed in all 50 states.
That's nice.
So if you're a novice investor, or you're trying to grow your portfolio, or even if you're an experienced investor and you've got properties around the country, we can help with that acquisition. We can help with that refinance anywhere in the country without having to pull your credit multiple times. And we can use that same credit report for multiple deals in multiple states. It's a big advantage for us also to be in this space because we have appraisal panels in every market that we're in. So like Memphis, for example, or Little Rock, for example, we have a group of appraisers who are familiar with the turnkey model. They're familiar with what you guys do, buying it off the courthouse steps, or purchasing a property that needs renovation. That's run down. Yeah. So our appraisers also understand, your guys' model. They will take your comps, a recent comp from you guys as a comparable sale, as opposed to maybe a big retail bank who only wants to take a comp from the MLS. And that's sometimes doing a disservice to the borrower or to the new buyer as well, who is again trying to get experience in building their portfolio and needs, to have the execution of a lender, but also the appraisal has to come, be fair, and not an appraisal that's just like, oh, the house down the block wasn't renovated and wasn't fixed up and wasn't turnkey, but that's not a fair value, right? So it's important to have that appraisal panel in place. For example, with our team, the execution that I push forward with those guys and with everybody on the team is such that, communication from them is the same communication that you get from me. So if a borrower doesn't listen to our team, it just flows back up to me and to Maggie, right? So I try to tell everybody that, if anybody from the team is reaching out, it's like me reaching out, right? Because it's all about getting your loan closed and getting you cash flowing as quickly as possible.
Right.
So cooperation from a client is paramount to getting a deal done successfully too. What else? Rates are always a topic of conversation, of course. Investment property, turnkey investment properties, the rate at times, I would never say it's not significant, but it's a little less significant on a $60,000 or $70,000 mortgage.
Right.
I know that a half a point here or a quarter point there sounds like a lot because, traditionally we're looking at our primary home rates and we're looking at refinance opportunities, and when you save a half a point, you save quite a bit of money. So that quarter point mentally in someone's mind is significant, but as it relates to a $60,000 mortgage, it might only be like $7 a month, So the key there is the execution. It's getting you positively cash flowing. It's closing quickly, and you can always concentrate on raising the rent over time, so.
Right. I love that. Yeah. Some people get so stuck in analysis paralysis of what my rate will be, and
Sometimes.
trying to timing the rate market when it's like, I mean, if you would have just bought it at any time, I mean, it's just buying consistently year over
Yeah.
year, regardless of where the market's at and appreciation. I mean, that's how most investors are successful, is they just are consistent and, number one, get started. So I like that you pointed that out.
There's a bigger picture outside of rate too, with owning the investment property portfolio and building the portfolio from an income tax perspective, right? Because you get the deductions on your depreciation, mortgage interest paid to the bank, the taxes and the insurance. And, ultimately you're reducing your income tax burden with your investment property portfolio, regardless of what your rate is, right? I mean, there's just a bigger picture there. But I will say that, rates are important. Don't get me wrong. It's just like, it's not, holding out for the lowest possible rate is not necessarily the best thing always.
Right.
What I tell folks is, let's lock your rate. Let's take what we can get right now. We've got 30 days or more to close your loan. Guess what? If the market gets better, we'll renegotiate with Fannie Mae and we'll give you a better rate, and it's a bonus, right? But when the market goes up, nobody calls me and asks me for a higher rate either, so.
It's true.
I think my position is take what you can get at the time that you're doing the loan, and if it gets better, it's great.
Yeah. So you mentioned some updates about COVID. So I know we're kind of on the tail end or going through a little bit, but some new discoveries you kind of made on forbearance. Can you go into that a little bit for us?
Right. Well, forbearance, I think was a great kind of offering or great from the industry to folks who were temporarily laid off or furloughed and did find themselves in a hardship as it relates to making their mortgage payments.
Right.
As it relates to the turnkey investors, we had a lot of calls from folks saying, hey, my tenant's not paying, because they did offer a short-term moratorium to tenants not being evicted if they don't pay, right? And maybe they were going through the same hardships of being furloughed and unemployed as well as a result of COVID. So a lot of folks, took advantage from the tenant perspective. They took advantage of maybe not paying their rent for a period of time. And then some folks would, enter into forbearance or at least explore forbearance because the tenant was not making the payments. Now, ultimately, either one, the moratorium on not being evicted or the forbearance is a short-term, kick the can down the beach kind of thing. At some point, someone's got to pay the piper, right? But as it relates to the mortgage industry, to the 30-year fixed rate, and to servicers in general, lenders like ourselves service a lot of our portfolio, a lot of our loans that we originate. Regardless of the fact that if anybody went into forbearance, we still have to make the mortgage payment, the principal and interest payment, and the taxes and the insurance to the county and the insurance agencies. So what we saw on some of the initial loan offerings or rates, the rates got stepped on by Fannie and Freddie. The lenders kind of like added margin to those rates to cover those few guys that do go into forbearance, and they have to make those payments on their behalf. So that was particularly evident in the cash out refinance transactions, because anybody who took cash out of a property and did a refinance and then immediately went into forbearance and didn't make a payment for 90 days.
Yeah.
It was like, the analogy of, the bad apple spoiled the tree, right? Because pricing and rates got kind of affected across the board for everybody in that particular transaction. So I think it's coming to an end. The thing about forbearance was there was no real barrier to entry to get forbearance, to get qualified or approved for forbearance, which is very unlike coming out of 08 and 09 with the housing crash and the appraisal valuation crash. Anybody that went into forbearance there had to prove the hardship, had to prove that they were out of work, and they had to document that. And it was very difficult to get qualified for that forbearance. But this time around, it was a lot different. I mean, you could just call the lender, call the servicer, and say, "I want to go into forbearance," or "What's your," just do it for 90 days, and it was an automatic almost. There was a lot of concern then about the guys that did go into forbearance and whether they could get additional financing and how long before they could get additional financing. And there was some guideline changes from Fannie and Freddie as that progressed and throughout the last few months that, if you go into forbearance, you just got to become current to get your next deal
Oh,
or
yeah.
to refinance or do something. So it did have an impact that wasn't very clear up front. And folks that went into forbearance did not know that it could affect them buying the house in 90 days time if they were, let's say, under contract for a new construction home that wasn't going to deliver until August or September.
Right.
So we did a lot of consulting on that, and kind of giving folks advice on if you did go into forbearance, what you need to do to get qualified for future deals. Or if you are thinking about going into forbearance, is it absolutely necessary?
Yeah. Options to consider. Yeah.
Right. Because after 90 days, you had to come current. And if you didn't, or you wanted to prolong the forbearance, it's at that point that you had to prove the hardship. And it's that point you had to document that, hey, I'm not going back to work for a while here, so that was where if you wanted to prolong forbearance or you want to get on a payment plan for 12 months, that you really need to prove that hardship at that point. So again, the barrier to entry for 90 days was not there, still isn't there, but I would definitely give your lender or give us a call to get some consultation or some advice on that before you kind of pull the trigger on forbearance.
Yeah, that's great insight, and it's such uncharted waters. So I'm glad you got your front end of it figured out.
Totally new to everybody, and this time around, like last time around, it was a little different and it was a little easier to manage because you had to have that hardship. I'm not saying that people didn't have the hardship or are not furloughed or not employed. I'm just saying that you didn't have to document it, whereas before you did.
Right. Well, good, man. Yeah, that's some great info, and I'm sure people can reach out to you guys or whoever to consider that if they are or think of going into forbearance. Kind of wrapping up here. What do you think are the main barriers investors have, or anyone getting started into real estate?
You mentioned fear of paralysis, and it's like sometimes folks are like they get so analytical. About it. I'm not saying it's a bad thing, but I'm like some over analysis can be, right?
Right.
At some point you gotta if you're willing to go forward and you have the liquidity to build a portfolio, again, thinking of the bigger picture of the income tax burden, not just the monthly ROI that it provides. Jump in and get your feet wet and learn the process, find a lender like us or find a turnkey provider like you guys that will work with you guys and show you what the management side of it's like after you buy the home. You learn what the tenant process is. Whether it's tenant renewal or tenant changing in tenancy and stuff like that, and then even the tenant management. The upkeep of the home throughout the tenancy, things of that nature. Those are the things that you need to identify in your due diligence up front, not just, let's say, the rate from a lender, right? So I would say don't overanalyze it. Certainly do your due diligence. But my advice would be let's get comfortable with a lender, right? I don't think you need multiple lenders in multiple states. Again, they're all going to pull your credit. It's going to hurt you at the end.
Right.
But ultimately, I think as you grow with the first property, if you're a novice investor and you get comfortable, then you're going to feel a lot more comfortable with moving on and building that portfolio. Fannie and Freddie allow you to buy 10 or have 10 financed homes. Beyond that, there's other product that we can share. I call it graduation day. So once you graduate, then we can talk about that loan product. But the first 10 properties are the most important really to get you off and get you started building your portfolio.
Awesome. Love it. And then lastly, how can people learn more about you? Reach out to you guys.
You can reach out to you guys. Obviously, you have our contact details, I think, on your website there. jmlens.com. It's joemaggilens.com. We're a branch within a larger company called Cross Country Mortgage based out of Cleveland. It's a big correspondent lender. I think they'll do about 16 or 18 billion in production this year nationally.
Right.
So we're a small piece of that, and our branch is JM Lens. So jmlens.com or go to your website, Sean, and get our contact details and just give us a call or shoot us an email. And again, we have a full team behind us, so we don't miss much as it relates to inbound calls or communication from any of our pipeline.
Cool. Well, thank you so much, Joe. Everyone, reach out to Joe if you need some more info on lending, how to get started. If you're looking into other states, he's in all 50 states. Joe, thank you so much. And Joe, I know you also help people buy personal residences. You focus mainly on investment, but I mean, you're basically the Swiss Army knife of lenders. You can help them out with a lot of things there. And if you can't help them, I'm sure you'll direct them in the right path. So thanks
Yeah,
so
I mean,
much.
there's some certain product we don't have. Like we don't do non-recourse self-directed IRAs, and
Right.
we don't necessarily do the construction financing, especially with the turnkey stuff. But
Right.
we've been in this game a long time. We've got colleagues in those fields and those areas, and we're happy to help and refer those out. It's the pond is big enough for everybody.
Right. Love it. All right, Joe. Thank you. Have a good one, man.
Thanks, Sean. Appreciate it. Bye.